Hey everybody, welcome back to another edition of Market Talks with Dr. Stoxx. This is Dr. Tom Carr, aka drstocks.com. I'm sorry, I'm Dr. Stoxx. drstocks.com is my website or our premium website. We also have a drstoxtrading.com where we have a couple of letters aimed at smaller account traders. But if you're interested in joining me in the live options room, which is what this is coming to you from, or the live trading room, and you can join both at a discount, go to the subscribe button, scroll down to live trading room or live option room, and you'll be given the option of adding the other one on at a discount. That's drstocks.com, drstoxx.com. All right. We've been in business since 2002 and happy to say that we're still going strong. Okay, so I want to start off by talking a little bit about the greatest trader in history. No, it's not Jesse Livermore. Despite the little subtitle on his book, which says that Jesse Livermore is the greatest trader in history, that's not true. In fact, Livermore was an amazing trader. He made several fortunes. He also lost several fortunes. And unfortunately, he died bankrupt and took his own life. So I wouldn't call that the greatest trader in history. Jim Simons is hands down the greatest trader. And he was very much of a trader, not an investor in history. He ran a fund. It was called Renaissance or something, and then it's called Medallion. Anyways, the same fund for, you can see there, about 30 years. Average annual return of over 60%. That is after a 5% management fee, which is unheard of in the hedge fund industry. I ran a hedge fund for a couple of years. I was only able to get away with 1.5%. Of course, I'm not. I'm not Jim Simons. Okay, but 5% management fee, and then a 20% performance fee, and that's where it started. And the better he got, the performance fee kept going up, and it went up as high as 44%. 44%, and he still managed to scroll out 60% on average over years. Now, look, if you had invested $100 with Jim Simons at the beginning of his fund in 1988, you would have $2.1 million. $2.1 million on just a $100 investment. Now, of course, hedge funds are only for accredited investors, so you wouldn't be able to invest with $100. But interesting to think about that. 2,103,217% return on equity after performance, after management, just crazy performance. Now, how did he do that? Well, he was a very smart guy, MIT, PhD in mathematics, and that was his approach. His approach to the market was not finance, was not even technical analysis necessarily, it was mathematics. What he did, he didn't hire finance guys, he didn't hire Wharton MBAs, he didn't hire people with trading experience. He hired he hired mathematicians and he hired physicists. The mathematicians, their charge was to find mathematical patterns between price and movement and time that kept recurring again and again and again, not only in the major indexes, but in the commodities, in the futures, in the Forex, and in stocks. He exploited those patterns. So he developed software that would note those patterns, find them, and then instantly trade them. And when the pattern came to an end, they would get out. And he kept tweaking those algorithms over and over again to maximize the returns, minimize the risk, and that was his approach. He once made the claim that he was making over 1 million trades per year, which is about 4,000 trades a day, if you can imagine that. I don't know how many trades every second, but it's a lot. Now he had a big staff, right? All of whom, by the way, were sworn to lifetime non-disclosure agreements. They cannot tell you how they did it. They can only tell you that they did it. Otherwise, they get into big trouble. So nobody knows his exact approach to the market, but we do know that he used mathematicians to find mathematical patterns. He used physicists to measure angles and momentum and other sorts of pattern relationships. And he put those two things together, right, the mathematical and the physics, into quantitative algorithms that just kept doing the same thing over and over again. Now, here's one thing we can take away from Jim Simons. No, two things, actually. One, his edge, and it is the greatest edge in the market, was the short-term prediction, right? Short-term prediction. And by short-term, I mean it could just be a few minutes, a few hours, at the most a few days, which is why he was trading so much, right? Because once you get out past a few days, your edge begins to dwindle. Now, that's not necessarily true for someone like Warren Buffett. If you're doing long term investing and you're investing in companies at a valuation because of margins and sales and equity and blah, 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 then your longer term view actually gives you the edge. But if you're trading the way he did, which is a mechanical, pattern based, mathematical based approach to the market, it's the short term where the edge is. And that's pretty much what we do, right? Pretty much. We're looking for patterns. We're looking for mathematical relationships, relationships between price, time, and momentum. And, I don't use any quantitative programs, but it's an interesting approach. So that's number one. Short term, for the kind of trading we do, short term is the edge. Right? Once you get out past that, that's one of the reasons why, and I learned this from him, not directly, but I learned it from reading about him. We trade day to day, right? One day at a time, always one day at a time. Always be open-ended to that next day after that. So we're looking ahead to tomorrow. Of course, we're also looking a bit at next week. But once we get out to like April 1st, I have a view, but I'm not going to hold to it. I'm not going to be wedded to it. I'm holding it very loosely. It can change at any time. So the other thing is that patterns are important, because they do repeat. And if you can find, you just take an individual stock or an index like the S&P. If you go back over time, you're going to see certain things setting up that then lead to very strong price movement. And when you see that same set of circumstances setting up again, this could be an oversold RSI, it could be stacked MAs, it could be volume starting to increase or decrease, ranges increasing, decreasing. These are all kinds of patterns that you see in the market. And when you see them positively correlated with very good, strong price movement, then you've got an edge, right? You've got a trading system. And that's another thing that we do. Okay, so let's look at some charts. And again, I apologize. We're going to have to be fairly quick with this, but let's get down to work. We're going to look at some indexes first. We'll start with the S&P 500. And as you can see, we started the day red after a very nice looking green day. That's our yesterday right there. That was Fed day. The day started fairly low, and as we were getting closer to Powell, it was starting to rise up a little bit. And then with Powell, it went up a little bit further. And then it was a pretty good buying until the last 15, 20 minutes. And then it did come back down. Very good day yesterday. Very good volume yesterday. The only thing it didn't do was take out the previous day's highs. Couldn't close above that. And that was a little bit of a problem, right? That kind of opened the door to something like today. Today, we started red. We started below the open of the previous day. We rose up pretty good early on to about 10:30, 11 o'clock. Nice straight shot up, and then slow trickle bleed down. And if I'm looking at the charts, we're starting now to pick up a little bit off of the lows. And we have remained above the lows of the day, the lows of the session. But here's the thing. Here's what is a concern. You have this long downtrend, and that is a very strong cascading waterfall down. Markets don't recover from that very quickly. The other thing that markets don't do very commonly is this sort of a V-shaped bottom, right? Markets, after falling hard like that, very rarely do they print a singular bottom that doesn't get retested or get broken with further downside before we finally get an equilibrium on valuation and on risk. And that's when you start to see the market get firmer and more reliably bullish. We're not there. We are not there. I've had guys in my Twitter feed, by the way, who've come out and say, the bottom is in, the bottom is in. Greatest buying opportunity of my lifetime, right? Back up the truck, buy all the mags. Yeah, but you know what? I don't know what these guys are smoking or what they're selling, but the chances are very unlikely that we will not see another leg lower of some kind. Also, right, soft little relief rally, fairly weak, low volume. Don't really want to see that. You want to see high volume on the bounce. And today is printing an inside day bar. Inside day bars after an uptrend tend to give you a couple of days of some weakness. I really don't think we're going to go down very soon. I think we've got tomorrow should be okay. Probably a tight, choppy range. It's an OPEX day. Probably see some volatility and a lot of volume, but maybe not a whole lot of price movement. Next week, I think Monday, Tuesday, Wednesday should be maybe a couple of days up and 1 or 2 days down. More consolidation, more of a sideways range building. Why is all that happening? Powell said it yesterday. Tariffs, tariffs, tariffs. And the other thing that he said a lot of yesterday, he said probably a dozen times, uncertainty, uncertainty, uncertainty. So the market doesn't like uncertainty. They like to have everything out on the table. Even if it's bad news, we just want to get it out there so we know. And that's not where we're at. We don't know if tariffs are going to come off. We don't know if there's going to be retaliation. We don't know what the impact on inflation is going to be. You know, our prices, if we're paying 25% more for food, I don't like that idea. 25% more for a new car, 25% more for clothing. Now, I do happen to think that April 2nd is the date, right? So we get out to April 2nd. That's that black line right there. We get out to April 2nd. I think it's probably a 65%, 70% chance that we get some kind of a de-escalation, some kind of an alleviation of the tariff warning, and it maybe not a complete erasure of them, but some sort of a negotiation taking place. In that case, especially if it's a really good backpedal, we should see the market do really well, right? But between now and then, if that happens, this is probably what you're going to see, right? Here's your V bottom. Over the next few days into that event, you're going to see a little bit of a cup form. And then if we're okay on the second, you're going to see boom, right? So that's a nice higher low with a breakout over the pivot high that usually ends the downtrend. Don't think that's going to happen. I think we're probably going to get up to April 2nd. We're probably going to get some sort of a mix of tariffs. It is just what it is. And then we go down, we test the lows down here at about 5,500. And if we're lucky, they hold, we get a double bottom with some bullish divergence. That's a pretty good chance I think that's going to happen, right? Especially if the tariffs are sort of like a compromise. They're on for another few weeks, and then they come off like end of April. Very likely that would happen. They're not going to be on forever. It's not a permanent thing. This is not a bear market or anything like that. As long as the adults in the room behave themselves, we should be okay by the time we get out to like early May. But a lot of uncertainty, as Powell said, and I think the path of least resistance right now is going to be a little bit of a sideways churn into April 2nd, and then we have to price in what will likely be an inflationary kind of macro to trade against. So double bottom would be great. Even if we come down a little bit, we violate that. We get down to about 5450 or so on the S&P. That still would be a pretty good place to build a base. It would be on top of still some other areas. You have to go down a little further, right? Down here, 5400. Areas of other areas of support. So we should be in a pretty good place if we can get down there without completely destroying the market. We really don't want to see a 20% correction in the S&P, and I don't think we'll get it. I really don't. 12, 13, 14% maybe on the S&P. Now the Nasdaq went down 15%, and it wouldn't be that hard for it to actually print a bear market, especially since it's driven by 7 or 8 stocks at the top, and all of those guys have some exposure to the problematic side of tariffs. So here's the thing about the NASDAQ. Once it broke that level right there, it was really sharp to the downside. We have a little bit of a weak rally, nothing to get excited about, nothing to start, feeling like, oh, the bottom is in. I really disagree with those people in my Twitter feed, and I will be totally happy and pat them on the back if the tariffs get taken off over the next few days and we just skyrocket back up to the highs, which is possible. Don't think it's going to happen. It's possible. But the way this is setting up on a technical basis, that, my friends, is a bearish pattern. Talking about Jim Simons in his pattern, this is a bearish pattern. And if you look back at bearish patterns like this one, you're going to see more downside more often than not. And, you know, the technical analysis 101 tells you that in a pattern like this, you measure the flagpole, right, from the beginning of it down to the bottom of the pennant or flag. There's your flag. And then the next move down is going to be the same length as that flagpole. I don't think that's going to happen. I mean, think we'd have to really have major recession for that to happen. But technical analysis 101, that's kind of where the pattern target is. It's down there below 17,000. And here we are at 19.8. So that would be nasty. That would be painful. However, there are some nice looking funds that are inverse to the market and they're leveraged and they are setting up right now. I don't think they're ready to go just yet, but they are setting up for some nice bullish price setups. Let me show you a couple here. So there's FNGD. FNGD is it's the leveraged 3x bearish version of the MAG funds, the MAG stocks. There's the 7 MAGs, and then there's 3 or 4 others that are in this one, and I think it's equal weighted. I forget. There's BULZ, which is one, and then there's BERZ is the inverse of that, and then there's FANGA now, and with FANGD the inverse of that, and I forget which one has. One has like 10 stocks, and one has 15, and one is weighted, and the other one's not weighted. I forget which is which. Anyway, this is a nice looking rally. So we've got a fresh 21 EMA crossing over the 50. They're both rising up. This is a new uptrend, but I think it's going to be short-lived. I do think it has one more leg, and it's setting up right here with this nice little pennant or flag or soft pullback into the rising 21. It held that, printing an inside day bar today, which is usually the end of that pullback trend. It marks a reversal, and I think it's kind of ready to go. I still don't think tomorrow or today, tomorrow, or early next week is the best time to get short, but it couldn't hurt for us to put on, and we're in the options room, so it couldn't hurt for us to put on some index puts, maybe even out of the money with not a whole lot of time, so they're cheap, as a way of adding some insurance. So we'll do that. I don't know if I'll do that today. Don't really have much time to get that set up, but we'll look at that probably tomorrow, pending market. Now, Bitcoin is a definite no-go zone. As a long anyway, it's setting up to short. Reversal today. That is almost a classic reversal bar. Just needs to set about 20, has to take out about 20 highs, and it only took out about 12. But it's a very bearish look right here, and you just don't want to be long Bitcoin, at least as a swing trade. I don't mind it as a long-term investment. I have some myself, but the next leg for this should be lower, at least to test the 76, 77 level. But I really think it's going to get down here to around 70, maybe even 68, because that's where that important line right there, huge, huge, huge. Right? Couldn't get up, then boom, 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 and right back down. This is what momentum stocks do. They break out, everybody gets on board, everybody gets sucked in, and the poor guy that got up here at 110 because he heard Tom Lee say that Bitcoin was going to 250 this year, right? He got sucked in at 111, 110. He's probably still holding and smoldering as we speak, but that's what momentum trades do. You don't buy them. You can buy the breakout, no problem. Don't buy the highs. Just do not. Oil is up today, and it actually looks quite good. You've got a nice little fresh breakout here, good volume. RSI broke out a few days ago. Always a good telltale sign when RSI breaks the downtrend before price does. It's usually an early sign to get in. Gold is up near the highs. I do think it's got a little more of a leg after some consolidation, a little bit higher, 3150. Yeah, 3150. I think it's probably going to top out there somewhere in early May, late May, early June. No, I'm sorry, early May, late April, and then it's probably going to come back in. And I tell you, when tariffs get taken off, if they do, and I'm sure they will, you're going to see gold just crash because it's pricing in inflation, is pricing in falling interest rates, it's pricing in a very weak dollar, and when you get rid of tariffs, all of that reverses. Okay, some of the mags, and then I'm going to have to let you go. Let's see. Apple is bad, 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 bad. So crack, crash, bearish, bearish little flag here. It's got 5 bars in it. And that's all you need. And it's just ugly. It's got another leg lower, and of course all that can change with tariffs, but that's what the chart is saying. Tesla, I think we are short Tesla with some puts in the room, and I do think that this will play out down to the downside. Maybe 200 is kind of where I'm thinking it goes quickly, and then maybe 180 after that. Why? Because it's just down, flag, down, flag, down. And Tesla's got all kinds of there are all kinds of issues right now with Tesla. I like Tesla. I think it's a good long-term hold. I've got it in the family fund. I've been a 7-year investor in shares. I'm averaged in at around $38, $39 a share. Not selling anytime soon, but it's not a long trade here. It is a short. Netflix is actually looked really good. It's probably still going to be okay. It broke out yesterday, very good volume, and we did a day trade on it into the other room. We got a 3% day trade using the leveraged fund, and I'm glad we got out because it is not looking that good today, but it's not going to go very far down, I don't think. Probably Netflix is going to be the one mag that you can jump on sometime between now and April, and I think you'll still be okay. Amazon looked very good early today, but what I like about Amazon is that if you go way back, you're at right on top of a big, long support trend line. You're down here in the pink zone of a slightly uptrending LRC, and it's not dipping any lower. And as the Nasdaq last week started coming down, 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 Amazon started going sideways, and that's outperformance, bullish divergence. So all good. RSI is rising off the bottom, and it did get to a very low bottom. And yeah, I think Amazon is probably going to be okay. Microsoft, I don't like. Again, fall, flag, fall, flag, fall, flag, fall. Qualcomm is pretty good, right? It has been bouncing and holding off of a very strong trend line around 150, and just looks like it's going to be okay, even if the market has another leg lower. I don't think 150 is going to crack anytime real soon. Yeah, I like it. And then it will last look at NVIDIA and then Facebook. So pretty good day today. A lot of the mags are red. NVIDIA is not. It had a weak day yesterday, so that's a little bit of a concern. Why was it weak when everything else was strong? But it's strong today when everything else is weak. And yesterday was the big investor day, right? Wasn't it yesterday, or was it the day before? Anyway, there was absolutely no bullish reaction to the Jensen announcements, and that's a concern. Lots of headwinds for NVIDIA. 120 is kind of a cap. 122 is a cap. Don't think it's going to get up ahead of any sort of change in tariff news. So just be careful. But we're long NVIDIA in the other room. So there's at least some hope for it. And what I'm hoping is that 115 has been a recent floor. If it comes back down and fills in a little base down here at 115, then I think that's a pretty good place, especially if we get a break in tariffs, for it to really print a higher low and then a breakout. That's what ends the downtrend. I'll show you this to you so that I can get this on the tape. Downtrends, right? They come down, they get a little bit of a relief rally, down a lower low, relief rally, lower high, down again. And then the way they stop is that they, hold on. The way these downtrends stop is that they print first a higher low, and then a higher high over the most recent pivot. That's typically where your downtrend or your long-term pullback or your correction, that's where they end. Lastly, Facebook, not horrible. You're down here holding the 200. It looked great this morning. It was breaking out on price basis. Got a little bit of a peak here over the 10 period moving average on the RSI. Pretty decent volume today and a light volume day. I think Facebook will be okay. So Facebook, maybe NVIDIA, Qualcomm will be okay. Amazon will be okay. Netflix will be okay. So if you want to focus on those for your big blue chip tech stocks, those would be the ones I would like to see you focus on. Guys, I've got to go. God bless everybody. Have a great rest of the afternoon. I'll see you back in the room in a little bit. I don't think I'm putting on any more trades today, but we'll wind up the day together. God bless. Bye for now.